Imagine two movies. In the first movie, prices fall because buyers back away. Sales slow. Listings sit longer. Sellers cut a little, then they wait. It's ugly, but it's survivable. In the second movie, prices fall because people are forced to sell. Not, "I'd like to move. I can't make the payment. I lost the job. The bank is taking the house." That second movie is the one everyone is talking about when they say the next 2008. So today, we're going to do something very specific. We're going to define what a crash actually means. Then we're going to compare 2008 to now using measurable mechanics. Not vibes, not doom posting, not "it feels expensive." Mechanics. And the claim is narrow. A 2008-style crash is structurally unlikely in the base case, even if prices soften. Not impossible, unlikely. Because a crash is not homes are overpriced. A crash is a chain reaction. So, let's lock the definitions. When I say crash, I mean three things happening together. 1. A national home price decline of at least 20% from peak to trough. 2. A broad forced selling spiral, foreclosures and distressed sales flying supply. 3. Credit contagion, the damage spreading beyond housing into the financial system. That combination is what makes 2008 feel like a different species of event. A soft landing or correction is different. Real prices can drift down while nominal prices flatten. Some regions can drop single digits, even low teens. But you do not get the national forced selling spiral. You do not get the systemic seizure. Now, with definitions set, we can ask the real question. Do we see the structural fuel for the 2008 chain reaction today? We're going to walk through 4 mechanisms that decide the answer. Mechanism 1. Forced selling fuel. Mechanism 2. Supply stress. Mechanism 3. Household payment burden as a proxy for credit stress. Mechanism 4. Nominal price behavior. How prices actually move when forced sellers are absent versus present. And in the middle, we're going to do the mandatory 2008 versus now comparison. Prices, rates, delinquencies, supply and construction, and debt service. Let's start where crashes actually begin. Forced sellers. Because without forced sellers, a home market can be overpriced, unaffordable, and miserable, and still not crash in the 2008 sense. A crash needs volume. It needs a large share of owners who must sell into a falling market. That's what creates the spiral. Forced selling increases supply. That pushes prices down. That creates more stress. That creates more forced selling. So what's the cleanest national signal we can measure for that kind of stress? Mortgage delinquency. Not the headlines, not the sentiment, the share of loans that are actually going bad. Here's what that comparison looks like. In early 2010, the national mortgage delinquency rate reached 11.49%. In 2025, the same national series is at 1.78%. That's not a little better, that's a different world. It means at the national level, you're not seeing broad-based payment failure. And broad-based payment failure is the upstream condition for a foreclosure wave. Could that change? Yes. The break condition for this mechanism is straightforward. An unemployment shock large enough to turn delinquency from low and stable into accelerating and widespread. But the point is, the crash machine doesn't start without that acceleration, and in this national data, it isn't starting. Now you might hear this and say, okay, delinquencies are low, but prices could still collapse. They can decline, but a national 20% plus peak-to-trough decline is not the normal outcome when delinquencies are low. Which brings us to mechanism 2, supply stress. Because even without forced sellers, prices can fall hard if supply overwhelms. So we need a supply indicator that reflects stress at the national level. One clean one is month's supply, how long it would take to clear inventory at the current sales pace. The month's supply for new houses gives us a long national time series. And here's what it shows. In January 2009, month's supply for new houses hit 12.2 months. By late 2025, it's 7.9 months. That's still elevated versus the tightest years, but compare the nature of the number. 12 months is a market choking on inventory. It's a market where supply is not just rising, it's sitting. Under that kind of stress, even small demand shocks can push prices down sharply because supply is already heavy. Today's number is not 12, it's meaningfully lower than the crisis peak. Again, could supply rise? Yes. Break conditions here look like this: a surge in listings driven by job losses or a sustained construction boom that outpaces demand. So let's check construction, because 2006 wasn't just about delinquencies, it was also about the pipeline. The Housing Starts series tells you how much new supply the system is trying to produce. In January 2006, starts were running at 2.273 million at an annual rate. By April 2009, they had collapsed to 0.478 million. That is what a supply cycle looks like when demand collapses and the system breaks. And it tells you something else. The mid-2000s period had a scale of building that simply isn't comparable to the trough years. The cycle had room to fall because it had been so high. Now, construction today can be rising or falling. It can add pressure or relieve it. But the point of comparing 2006 and 2009 is to understand what a true housing-led unwind looks like in national supply data. Crashes are not subtle. They show up as violent shifts in stress indicators. Now we move to mechanism 3, payment burden. Because delinquencies are an outcome, payment burden is part of the upstream pressure that can create that outcome. One broad national proxy is the household debt service payments ratio, total required debt payments as a share of disposable personal income. It's not housing only, but it captures whether households, in aggregate, are stretched. Here's the comparison. In late 2007, the debt service ratio peaked at 15.846%. In 2025, it 11.256%. That gap matters. Not because it guarantees safety, not because it means everyone is fine, but because it means the system is not starting from the same aggregate level of payment strain that existed going into the financial crisis. Which brings us to the most important part, prices themselves. Because people remember 2008 as homes went down. That's not wrong, but it's incomplete. The critical question is, how far did it go down nationally and under what conditions? The National FHFA Purchase-Only House Price Index gives us a clean peak-to-trough pattern. In the first quarter of 2007, the index reached a local peak. By the second quarter of 2011, it reached a trough. That peak-to-trough decline is about 21%. That is right in the zone of our crash definition. But remember, the definition requires more than a price decline. It requires the forced selling spiral and the broader credit damage. Now, compare that to the most recent reading in the same FHFA national series. As of the third quarter of 2025, the year-over-year change is about plus 2.25%. So the recent trend at the national level in this series is not a rapid negative collapse, it's modest positive year-over-year growth. Does that rule out future declines? No, but it matters because crashes don't usually arrive as modest positive year-over-year growth. They arrive as deterioration in stress indicators followed by sustained negative momentum. So now we've built the machinery. Let's do the explicit 2008 versus now comparison, point by point, using only these national series. 1. Price dynamics.
2008-era crisis in national prices, peak in early 2007, trough in 2011, about 21% in the national FHFA purchase-only index. Now, the same national series shows about 2.25% year-over-year growth in 2025 Q3. That's not a crash print. That's a stabilization print. 2. Mortgage rates. Rates matter because they shape demand and affordability, but rates alone don't create 2008. They interact with stress and supply. From Freddie Mac's PMMS data, the average 30-year fixed in 2008 was 6.03%. In 2025, the average is 6.60%. And the latest weekly reading, available in early 2026, is around 6.11%.